Welcome, I'm Catherine Magana here with Vince Stefano, where we're here to provide some insights about the market and some planning. So here we are, it's June 27th, we're almost mid-year, halfway done with the year, finishing up this quarter, and it's been an interesting year. I mean, obviously we're finishing this first half of the year, we've been in positive, we've been in the green in a lot of different indexes. I was kind of looking at where we're at with some of the major ones we look at, and the Dow Jones is up almost 4% year to date. The S&P 500 almost 15% this year, and the Nasdaq up almost 18%. But the Russell 2000 is actually down a little bit this year, which is more the small cap stocks. So it's just kind of interesting as you kind of reflect and see where we're at for the year. And obviously along the way, it's been a little volatile, but it's, I can't complain where we're at. If we could stay where we're at for the rest of the year, I'd be happy. I think we're obviously in an election year. And so this is the first time, I think, since 1976 that we've had this much gains in an election year.
Yeah, and right now, as Catherine said, just to kind of play off that, when she was reading off some of the industry returns, I was listening to one of the business reports, and I think it was either CNBC or maybe Fox Business, I'm not sure, but they said if you looked at Microsoft, Amazon, Google, Meta, Lilly, and NVIDIA, it's held by 80% of the index funds. And that's why a lot of these broad indices have done fairly well. But when you subtract those out, and I think we've mentioned this before, if you subtract that out, the indices have not done all that well. And so what we're now seeing is people are becoming a little more short-term bearish, but they're still long-term bullish, which is kind of interesting because we've seen a nice run in the market. We've seen some nice gains over the past 12 to 18 months. And I guess the big question now is we're coming into Q2 earnings season, which is going to start big time around July 8th, the week of July 8th. And the question on everybody's mind is, will the mega cap tech stocks continue to lead? Or are they getting to a point where, the tyranny of large numbers is starting to take over? Or will we see a broadening of the market and see other types of stocks that haven't participated very well all of a sudden come out and start showing some better earnings and revenue? So I think it's going to be an interesting Q2. And I think that's also why you're seeing a lot of the, especially like the Russell 2000, why that has underperformed, because that has, and not only tech stocks, but has a lot of financials and energy stocks that are in the index. So.
Well, it's interesting. I was looking at the S&P 500, and over the last 18 months, it has not had a daily 2% decline. So it's pretty much, we've had a pretty big run up, like you said, with AI stocks and some technology stocks really, leading the way with that sector or that index. So there was some information that just got released. So it looks like the May pending home sales fell 2.1%, where there was an expected 0.5% increase. So that's obviously some news that just came out. And then also mortgage rates, I was looking at, they actually declined, and on a national average, it's about 6.86. So it's not the 2.5%, 3%, but obviously it's not 7-8%. So that was kind of interesting. And kind of going back to the home sales, that was a national number. I was also looking at kind of on a regional basis. The Northeast sales were actually increased 1.1% on a monthly basis, on a month-to-month basis. In the Midwest, it fell. In the Midwest it fell, and in the South it fell 5.5%. And in the West, which is where we're at, it was up 1.4. So it's interesting because you're in different areas, and real estate fluctuates and changes. But on a more of a national level, it obviously pending home sales are down, and that's not surprising considering interest rates where they're at. And if you have a really low rate, unless you have to move or you want to downsize, I see a lot of families wanting to stay where they're at right now.
I agree with you 100%. And, it's also interesting, and I think we talked about this a little bit at one of our previous podcasts. We were talking about interest rates and how, retirees could be falling into a cash trap. And I know, Catherine, you do a lot of financial planning, so I'm going to mention some of this, and you can jump in right after this, and then you can go from a financial planning standpoint. Yeah. But I want to just say right now, the 3-month Treasury is about 5.3%. So that's pretty darn good. The Wall Street Journal had an article a couple days ago where it said $6.1 trillion is sitting in money market funds. Mm-hmm. Many retirees, and I mean a lot of retirees, have upwards of 60% of their assets in cash holdings. Wow. Now, I don't know if that's treasuries or if that's just money markets. Mm-hmm. But if the Fed begins to cut rates, and I don't know when that may happen, but eventually it will happen. How is this going to affect a lot of these retirees? Because they're going to need to rebalance, and they're going to have to rebalance into either bond portfolios or stock portfolios. The problem's going to become if the cash levels start to decrease, inflation is going to eat into their profits dramatically. And also there's our tax specialist isn't here, but you have to remember that interest on money markets are taxed as opposed to dividends. Some have special dividend taxation. So from a financial planning standpoint, I mean, what's the advice here?
So usually our clients have a financial plan, a retirement plan, and we usually don't have that much in cash. But if there's an average investor or somebody that's a retiree that aren't working with planners, perhaps they do have a lot of extra cash set aside. And currently where interest rates are at, on the short end of the curve, like you mentioned, there's some really attractive yields. And if they're living off that income, it's working. But eventually those yields are going to change and they're not going to have that 5 or 5.5% interest that they're getting. And it could go back to where it was a few years ago where you're getting 1 or 2%. So in a kind of comprehensive financial plan and retirement plan, you're going to have a diversified portfolio. You will have some cash, you'll have some fixed income, and you'll have some stocks. So kind of a combination. Usually we do that, and it's kind of based on each individual investor. We factor in Social Security, we factor in pensions. Is there any real estate? So kind of looking at everything. Where's the income coming from? How are your investments positioned? And what's the income you're getting from your investments? So typically we don't work with clients that just have a lot of cash like that. But if there is somebody in that situation, we love to help and kind of guide them and navigate through that. Looking at the Fed, they want to get the rates back down to 2%, which we're not going to see. Potentially now we're seeing they might be a few years before we get there. We also are hearing potentially, are the Fed's going to lower rates? We're hearing perhaps one time this year. So kind of looking also historically where some numbers have been, just to get in perspective with different investments. From September of 2007 through March of 2024, which is first quarter, over that time period, the S&P 500 index, which is mostly stocks, that annualized 9.9%, so call it 10% approximately, versus we had 10-year treasuries in that same time period yielded 2.6%. So there goes your question. Yes, now it works, but the reality is over a longer period of time, those differences in returns will make all the difference in your retirement and what you need. And once again, and it's not a one-size-fits-all. It's really looking at each individual client and designing the portfolio and strategy based on that.
Yeah, because I was going to mention something about, stocks and especially for retirees, buying some very high quality, rapidly growing companies that do pay a very nice dividend. If the Fed does start cutting rates and, as you said, can it go back down to, 2.5% on the 10-year or 3% on the 10-year? If inflation doesn't come down along with the reduction of fixed income rates, your real rate of return is going to be nil.
Yeah. Usually we see inflation is usually lower than some of these yields, but at this point right now, inflation is lower than some of these short-term yields. But that's not common. We don't see that very often, but that's where we're at right now. But yes, you definitely want to factor in inflation. How does that impact? So this kind of ties into some kind of planning techniques to think about as you're phasing into retirement. If you obviously need to take Social Security, so we look in the financial plan when's the best time to take it. It really depends if you're working or not, and if you're married and what the ages are of your spouses, and what other assets you have. So it's really kind of case by case on when you should take Social Security, and we run some different scenarios to see what's the best benefit. In addition to that, as you're phasing into retirement, we look at required minimum distributions, and that age keeps going, later and later, went from 70 and a half to 72 to now 73. But as you're phasing into that, or when you need to start taking your required minimum distributions, prior to that, there might be some years where you could do partial Roth conversions. And then as you are going to take required minimum distributions, you can also do what's called qualified charitable distributions, which allows you to donate to charities and not have to pay taxes on that money as part of your RMD. So there's some tax planning, which we'll bring Rachel in on when she's here, that we look at as we do our financial planning and retirement plans. And then also looking at, if you are phasing into retirement and you need income from your investments, where's the best place to take the money from? And so there's some planning there to make sure that we're being tax efficient with some of our distributions that are going out to our clients, whether it be coming from taxable investments or from your retirement assets. So
I guess the other question, and again, I guess it's each individual investor, but I think a lot of investors are starting to get a little spoiled with the equity returns. I know that. I talk to people, and it's always like, hey, what do you think the next 6 months to a year is going to bring? And I wish I had my crystal ball. Sometimes gets a little cloudy. I think equities, like you say, long term, they're going to continue to do quite well. And again, those numbers that you kind of mentioned, 10% or so on the for stocks and 2+% for bonds. I think that's pretty much historical rates in those returns. So, again, I think that if investors have a lot of gains in their stock portfolios, maybe depending on how bullish or bearish you feel in the short term, maybe you take some profits. Maybe you lock in a little bit of this high rate cash return. And then if the market does decline, take some of that cash and, reinvest it somewhere. I guess the big question is the market's never going to ring a bell to tell you when to get in. It kind of tells you when to get out when it starts dropping precipitously, but it never tells you when to get back in. And so a lot of people all of a sudden start coming up with that, get me in because I'm missing out. And
the FOMO.
FOMO.
Fear of missing out. And that kind of gets me thinking then about if you have cash, like you talked about earlier, if somebody has cash on the side, how do you, when those rates change, what do you do? Are you going to be stuck with lower rates? Another thing to think about is dollar cost averaging. You're buying into the market over time. You're not putting it all in all at once, and you're slowly putting that money to work. That's another strategy, especially if long term, that money is meant to be invested. So there's a lot of different planning and strategies. Obviously, we're approaching the end of the first half of the year, and hopefully it'll be as good the second half as it was this first half.
Well, like I say, I'm looking into second quarter earnings right now, and I'm really eager to see how well some of these companies are going to do, especially some of the retailers, because the retail sector has been fairly strong, and the consumer has kept this market going. Yeah. So I'm eager to see if they're going to continue, especially with the high levels of, credit card debt right now. Guys are, some consumers are tapping their 401k and their IRA to make ends meet. So I'm eager to see how these companies are going to do and see if they're, what their guidance might look like going into Q3 and then the rest of the year. So, hang on, keep your hands and feet inside the ride, like I always say, and, let's see what the market gives us.
Great. All right. Until next time, we'll see you next week. Thank you.
Thank you.
Please stay tuned for important regulatory disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Wolf Wiese Magana, LLC, doing business as WWM Financial, Savvy Doc Financial Planners and Savvy Woman Wealth Management is a registered investment advisor with the SEC.